Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone. Welcome once again to the Top 5 at 5. I'm thrilled to have somebody who's an expert in energy, director of research at Raymond James, and the energy analyst. So, Jeremy, great to have you with us today. Thanks so much for joining.
Yeah, thank you.
Jeremy, why don't we start from the top down? I think, people are still trying to understand what is going on with Russia and Ukraine and why that has put such a squeeze on the energy prices. And of course, we got the US inflation data out at the highest reading we've seen in 4 decades today.
Yeah, this was a bit of the making, for quite some time here. Ever since COVID started, you've seen a lot of the OECD countries really cut their spending on oil and gas development. There's been this mantra that maybe we've hit peak oil, and COVID was the start of that. And so you really start to see an underinvestment in oil and gas supply over the last 18 months. And that undersupply was really starting to be noticed here, especially last fall and really this early January, when you start to see inventories globally really start to fall to some of their lowest levels that we've seen in quite some time, probably 3, 4, 5 years here. And suddenly, when you have the Russian-Ukraine conflict and risk that you bring on even less barrels, it's a real serious issue here. Russia produces 11.5 million barrels, 8 million of that gets exported. And that's where suddenly, if those start to come off the market here, you really do get yourself here in a pretty tight squeeze.
And what is the latest, though? Because there have been calls for sanctions on Russian oil, but of course, Germany gets 70% of their nat gas and oil from Russia. That would, I would think, absolutely cripple their economy, let alone their ability to defend themselves or defend anybody else, should that come to be. So where do we stand on that conversation right now?
No, that is 100% the issue that the world is facing here right now. It's easy for Canada and the US to say we don't need it. Russia only exports about 8% of their oil and products to the US. But when you have rest of Europe, who needs much more, so Denmark is up there with Germany and more of the Eastern Bloc countries, you don't have that broad support across Europe, and that's why you've seen some of these problems and why this has taken so long for different countries to impose sanctions. And even some can, others can't. But I think it may not stop there. You may not actually even need sanctions so much, because you can already see the blowback in an ESG type of world here now. It is dangerous for a company to be seen doing business with Russia. So it may be legally allowed, but you look at Shell, for example. Shell bought a train of oil, back in, earlier at the beginning of the war, and actually went on social media and said, look how cheap we got this oil from Russia. And then suddenly, banned Shell, started trending on Twitter here. And then you see a couple of days ago that Shell has said, we will no longer do business with anything Russia. So you can see how there's a lot of corporate, awareness that we cannot be doing deals with Russia. Even this morning now, Goldman Sachs is pulling out of Russia. So it's just one by one, all these major organizations that are leaving. And I think that's actually going to be more the impetus that actually changes things here, is not so much the legal ramifications from governments, but the corporate ESG angle that is really going to limit the amount of supply that Russia actually is going to be able to bring on here over time. Yeah, that's I think what's been so interesting about these moves from various companies, whether it's LVMH or now McDonald's, as you mentioned, Goldman Sachs. So many. This is really being driven by corporations and ESG. It's not always just about the environment; it's about good corporate governance, the G in ESG, right. And not waiting for governments to actually do it, but the corporations are actually leading the charge here. Yeah, and this is the thing, like, we've never seen this type of action before from anybody, really, for any, like, going back in history here. So I think this is one of those items that I think the Russian oligarchs and Putin, didn't probably appreciate how much the world has a focus on ESG here now, and how much this actually is going to be hurting their economy more than what they probably thought.
Yeah. So when we think about the impact on energy prices, the other aspect too that you bring up in your note, which I think is or your comments, which is so interesting, is that, even if you didn't have sanctions on Russian energy, there probably are sanctions for companies doing business with them in terms of rigs and equipment and parts. So that would impact their ability to produce anyway.
All of it, the logistics, a lot of the oil that comes from Russia here, the new stuff, about 80% of their oil is old conventional declining oil. So to get new polymers or proppant in, you need Western technology. Some of the offshore growth that they plan. Once again, you need Western technology here. So not only the technology and personnel, but you also have logistics in terms of insurance for boats, aircraft, sending spare parts to pumps that go down. There is just a number of logistics that I don't think is maybe fully appreciated in terms of, here's some government sanctions, but a lot of these other companies that, do business have just said, we don't need to do business here anymore. I think a good example is Venezuela. When Venezuela was, a major OPEC country, and you see how much their production has gone in decline over the last few years with sanctions, and the sanctions that seemingly are applied to Russia just with the ESG angle here, I think could actually, make it much more of a bigger issue here long term. And, Putin may be able to negotiate, probably peace and try and get, the sanctions reversed, but it still comes back to an ESG angle where maybe guys just don't want to be seen doing with business with Russia, even though these sanctions were reversed here. So I think that's what's going to make energy, especially oil here, elevated here for quite some time.
So so talk to us a little bit about the price action, because the price action, I can understand why it went up. There's been a lack of investment, not just over 18 months, but for many, many years. But yesterday we saw WTI down by over 10%. That's a major move.
Yeah.
Where are we from your perspective in terms of where the price action should be based on supply constraints, the potential for demand destruction, and capacity?
Look, I think we're all just sitting by our computers here, just waiting for every little piece of news that comes out. And it's so rapid and so many moving parts. Even a few days ago, oil was up to, 130 and then came all the way back down to 115. And it's, is there peace? No, suddenly there's no peace off. And then Russia will not make an announcement saying we're banning all raw materials. And then you're like, well, is that fake news? Is that real news? Do we believe that here? And all these, tweets, I almost want to say, is really whipsawing the market back and forth. And I think everyone's kind of trying to grab at straws here, saying, what do I believe? Is this real? And just trying to get a bit of an edge here because the volatility is so incredible here right now.
Mm-hmm. And so, that's a good point. I mean, it's really moving on headlines and the potential for, some type of peace or off ramp. That's been the biggest concern and issue, really, in terms of how does Putin walk this back? We'll see. Nobody probably knows. But in the meantime, though, where do you think demand destruction will play into this equation? Because at some point, I mean, there's a lot of consumers everywhere that, they're not going to be able to, pay for anything other than their gas and some food.
Yeah, I think that your demand destruction will, obviously is going to start taking effect. It will probably start taking effect even at $90 oil, and every incremental increase, it's more and more and more and more. I saw a recent study here that said if you actually look at 2008 and where inflation has moved since 2008, the equivalent oil would still be around $220, where we really start to see demand destruction. You remember that's when we saw, taxis and airlines were all charging those fuel surcharges. So we're not quite to that level yet. In Canada, though, it's a little bit different because back in 2008, our dollar was more or less parity. It was about 94, 96 cents, right around there. So at 75 cents here today, more or less, it's actually probably one of the most expensive that we've seen oil priced in Canadian dollars. So it is going to probably hit the bit of the pocketbook here for Canadians more than Americans. But just some little nuances here. Not to mention the carbon tax and other additional fuel taxes have been added. So it will start to hurt demand, but on an inflation adjusted basis, we're not quite, for American consumers, we're not quite to where we were in 2008.
And so where does that leave you in terms of looking at investment opportunities in Canada or the United States?
Yeah, it's who would have thought 18 months ago in the midst of COVID, when it looked like almost the entire E&P space could have gone bankrupt. Here's where we are now. Like I said, oil priced in Canadian dollars is one of the highest we've ever seen here. And it's when you think about that, and then where costs have come down for these companies and the efficiencies on wells, this sector is probably the most profitable that it's ever been in its entire history here. You remember back in 2008, this is when horizontal drilling for oil just got started. So for the most part, we were still drilling vertical oil wells. And so now you put that high price again on what companies can bring out of oil, like an oil well now, with the technology, it's pretty remarkable. Like most companies get about 4 or 5 month payouts on their wells that they're drilling today versus 2 years ago, versus 2 years, even just a few years ago. So it's pretty remarkable. So when you say, well, what companies specifically, a lot of them can do well, but always when we look at stocks, we always want to, so the oil will do what oil prices do, but what specifically? So probably there's a few nuances that we're looking for. And one of the biggest ones is who's in the newer plays, who's in the top economic plays, because even if oil declines, if you're still in the top play, that will work. So, a name like Tamarac would be one of one of our strong picks here. Tamarac is your, a Clearwater operator, 40,000 BOE, 45,000 BOE, and continuing to grow. And when you look at Tamarac's history, it used to be a Cardium Viking operator. And when we look at, the kind of the 100 plays here in Canada, those plays would be kind of third, fourth quartile. And so when you have a company making a shift from, kind of below average plays to the top decile plays, that changes a lot of way the market should look at that valuation multiple. And so we haven't seen that valuation multiple move yet. And I think that's one of the biggest things when oil will do its thing, but who's shifting their company portfolio to be a much better play here.
So I got to ask you, when you say play, what does that mean?
So play means the type of area that you're going after. So we always hear about Permian oil or Bakken oil. So here in Canada, there's probably 5 main plays. You have your Clearwater, which everyone investors are quite excited about. It's kind of the newest play here. We have the Montney, we have the Cardium, the Viking, those Duvernay, those would be your 5 kind of main plays that we have here in Canada.
Got it. And so the way though Tamarac has shifted their play is a positive for you. And it sounds as though you don't think that the market's really caught on to that there should be a bit of a valuation catch-up trade.
Yeah, that's right. And so we always look at, like oil, like a lot of these names have moved up because the price of oil has moved up so much. But depending on which way you can look at valuation, in a number of different ways here. But for the most part, just taking on a very simple way, looking at EV to EBITDA, the sector average would typically trade around 5 times historically. Today, they're trading closer to 2 times. And so, and that's pretty much across the board here, 2.5 times. And so when you have a company who's in a top tier play, you should be willing to pay more on that multiple versus some other companies that are in just not quite as economic places as that.
Interesting. Let's take a look at another top pick for you, Tourmaline.
Yeah, Tourmaline, and I'm going to group a couple of the other BC producers here in this. So Tourmaline is your bellwether operator in Northeast BC, largely gas, $14 billion market cap here. But their valuation has been hit here slightly because with the Supreme Court ruling last year that basically stopped all new oil and gas licenses in BC, every time we talk to different US investors and we start talking about concerns, and we bring up the Indigenous and the BC royalty review, it's a non-starter then. they say, you know what, I'm going to wait until those items get resolved, and then I'll come back to look at Tourmaline and some of these Northeast BC operators. And so you look at Tourmaline and some of the economics that it has. Once again, it's a top quartile economic, company here, but its valuation doesn't reflect that, because there's a concern on what does the BC royalty review actually do, and when does the Indigenous Blueberry River First Nation issues get resolved here. So that being said, some of talking to different guys and different in the field here, we get the sense that the BC royalty review has probably done all the same economics that Alberta did when we did our royalty review back in 2017. And a lot of the things that we did with our royalty review actually makes a lot of sense here. And so you'll probably have something like a post C-star, what that basically means: you low royalty rate up front and then a higher royalty rate, post the back. And I wouldn't be surprised if it's very similar to Alberta here, that we'll hear in the next month or so. Same thing with the Blueberry River First Nation. They elected actually a new chief here that took over on February 15th, who actually happens to own an oil field service industry or company. So you can kind of see the Blueberry River First Nation bands changing their tone possibly here, and voting with and voting someone potentially more business orientated. So anyways, I'm hopeful here from what the outcome of these two things here are going to be. And I think once those are resolved here shortly, you'll see some of these valuations and U.S. investors really start to come into, Tourmaline being, the biggest. Just to finish off on that, with LNG being more and more topical, and the change of tone from government here just in the last week, that maybe we do need more LNG here in Canada. If anybody wants to build LNG on the West Coast, they'll likely have to source that gas from Tourmaline, and Tourmaline's been pretty well known that they want price participation and a kind of any LNG contracts here. So that's where you look at Tourmaline and say there is a lot of free cash flow that is going to continue to come to this company.
Nice. Full disclosure, I own it. So good to hear those views. Thank you. And where does Whitecap fit into the conversation as another top pick of yours?
Yeah, so once again, Whitecap is, similar to what we saw with the Tamarac, going from, third, fourth quartile plays to much more top quartile plays here again. And those are always the names where you see the biggest multiple move every single year here. And so as Whitecap moves more into, especially the Montney, and you start to look at Whitecap's Montney results, I would say Whitecap has probably drilled the fourth best Montney well here in the last year. And it just kind of shows you what the potential here of their Montney Lake acreage could actually do. So you can still buy Whitecap for an oil name. What you can still buy Whitecap without the Montney multiple here is basically. And so as more and more production shifts from kind of Cardium, Viking to Montney, Charlie Lake type plays, that's where you should start to see that multiple expand here. But one of the biggest holdbacks on Whitecap here over the last year was their acquisitions that they bought. There's an overhang of stock with what some of these shareholders would do here. And just given the amount of cash that Whitecap has kind of built up in their free cash flow, it sounds like they are going to just use that for some very big buybacks, strategic buybacks here whenever that stock comes available. So this perceived notion of a stock overhang is really actually overblown here, because given their new NCIB, they're waiting just for when this shareholder is looking to sell, and that overhang is really kind of overblown.
Understood. In the interest of time, your other two top picks, Vermilion and Enterprise. Why both of those names?
Yeah, so quickly, one of the problems in Canada here is even if we want to increase oil to, move off Russia, we're restricted by pipeline capacity. But you have Enterprise, though, who's in the North Dakota, and given the expansion of the North Dakota pipeline out of there, there actually is quite a bit of more excess capacity out of any kind of play here in North America. So if someone does need to expand production, Enterprise does have the capacity to actually expand their production here. I don't think they necessarily potentially do, but things always change kind of thing here all the time, especially if they're being kind of asked to probably increase production. It kind of gives them the catalyst to actually do that, because the economics that these companies make is pretty robust, but shareholders have been pretty adamant that we want shareholder returns as opposed to growth. But I think this may be the catalyst to expand it. And then quickly on Vermilion, same thing. They're the number one oil producer in France, number two, gas producer in Netherlands. As Europe tries to get off, Russian energy, I think these domestic producers in Europe are going to be asked to step it up. And the only reason why Vermilion hasn't been able to increase their production is because delays in licensing and just the regulatory body in terms of getting well licenses. I got to think that speeds up, and Vermilion should be really able to be able to take advantage of kind of the crisis going on there.
That's interesting. I've interviewed the previous CEO many times, and it's a Canadian listed company, but the business is overseas. And they did, there were many times they were struggling with their quarterly results.
Yeah, and that's why one of the reasons why investors have somewhat moved away from Vermilion here. There's just been a number of issues over the last few years, especially during COVID, where they paid too high of a dividend, got themselves into debt trouble, slowed down on spending, but it just somewhat all unraveled there. So fast forward in a few strategic acquisitions, buying some very big gas assets here in Ireland, that's going to be able to fund, UK energy and that. You look at the gas prices in Europe here, and it's bouncing around between, $100 an MCF. Like, it's just like, we're modeling, $15 MCF. So, clearly we need to adjust our numbers here, but it's hard for, I think, anybody to say, well, what is the right price to use here over the next couple of years? So I think that's where everyone's still kind of using these low numbers, but, you start to look at what the cash flow could be for Vermilion. It quickly delevers the entire company and puts it back on a really good footing here going forward.
Wow, interesting. And you don't think it's really captured in investors' mindsets yet?
No, it's just there's a bad history, and so it takes some time for guys to come back. I know it has moved, but given how much the commodity has moved here, especially in Europe, Vermilion is. If I take the current strip price, Vermilion is the cheapest name in our entire coverage list here today.
Interesting. Very interesting. And Jeremy, we're going to wrap it up, but before we do, we started the conversation, which wasn't recorded, where I asked, are you getting a lot of calls from investors, institutional investors? And so what do you see with that?
Yeah, so, calls have definitely picked up here. But I find the calls are still more, high turnover funds, hedge funds, and we still haven't seen the big generalist funds come back into the market inside, and just inbound calls, and you kind of look at trade on our trading desk here. You still see some hesitation, knowing, is this run real? And we'll wait for a pullback here, and I think that's what it's just things have moved so quickly here. It just takes the bigger generalists more time to come into the market, but I think you've started to have conversations, and they are definitely having a change in mindset that, wait a sec, maybe energy is going to be around for quite a bit longer here than maybe we appreciate it.
And on that note, do you have a price that you can see for WTI over the next, 6-12 months?
Wow, we have our official price deck, which wasn't updated since last January, which kind of stands at $78 here. Obviously, given situations have changed, but just given how tight the market is, what OPEC could really do here in terms of the near term, and what Russia, it's honestly anybody's guess. Could oil go to $150? No problem, kind of thing. We are really in this uncharted territory here, and I think there's a lot of nuances that it's difficult. And I think that's the problem with a lot of the CEOs who I talk to, is they just say, we don't know how to make an investment decision here right now, because we don't know if oil's going higher. Should we hedge, or is oil going lower? And do we expand our spending? There's just too much noise and too much volatility here for anybody to do anything. So the longer this plays out, the longer lack of supply comes on and just exaggerates the situation here.
Interesting. And just lastly, what is the latest read on OPEC and the UAE?
So even just like a couple months ago, so OPEC meeting in February took 16 minutes, and they're like, yeah, let's increase our production 400,000, kind of keep with the same plan, which was one of the shortest OPEC meetings ever. And then in March here, just a week ago, it was 13 minutes. And it was just like, wow, you guys are all in agreement here, which is, it's like in 13 minutes, and you're like, yep, stick with the plan here. So that's what caused oil to move up a little bit. And then till yesterday, where the UAE and Iraq both came out and said, well, wait a second, here, maybe we need to have a broader conversation about increasing supply. And so that's what caused oil to drop, $10, $14, yesterday here. And so now it's going up again. And I think everyone's kind of looking at logistics, because you look at OPEC already, and they're already coming short with a number of other members not being able to even meet their current quotas here, let alone expand it. So I think I think there's coming to the realization, maybe we don't have nearly enough spare capacity as we all kind of claim we do here.
Right. Oh, that's helpful. And then just lastly, Iran, what might we expect there in terms of any type of supply coming onto the market?
Yeah, Iran and including Venezuela there as well too. It's interesting how government officials are going saying, you know what, we're good. You guys want to bring on your oil here once again. So a complete game changing. But Iran was still producing quite a bit of oil and supplying of that to China and a few other countries here that didn't participate in the sanctions. So Iran can probably supply some oil, probably about maybe 1 million barrels here near term, but nothing, and probably more over time here, but nothing to really replace Russia in the potential that we could see in the terms of the sanctions and the downfall of supply that Russia may be able to provide here.
And would there be any room for Canada to supply the United States should they need it? And where does the Keystone XL pipeline fit into that?
Yeah, TransCanada said they're not going to restart these conversations, so that seems unlikely, I guess, here right now. We do have rail capacity that could move higher. We still do have could probably increase our production by about 5-10% in terms of our exports, but you really are trying to get then creative in terms of some of the things that you could do. But for the most part, though, we are really limited in terms of what we could probably provide here to the US.
Interesting. All right, Jeremy, we will leave it there. Great conversation. I think it's really going to help a lot of people understand what's going on and all the different dynamics, as there are so many, as you pointed out.
Yeah, thank you for having me, Catherine.
Okay, great. Speak to you soon. Thank you.
Bye.